The economy isn't doing well, but assets are insanely expensive. Like everything is just super pricey right now. Honestly, at this moment, don't trust the global financial system. The National Bank of Denmark has even come out and warned its citizens not to rely on just one financial system. For example, don't just trust online banking. Withdraw some cash and keep it on hand in case any crisis happens that could affect stability or finances. This is a real warning. Similarly, the National Bank of Sweden issued a warning this past March, saying that events could occur that would impact financial stability and security, and that people need to be prepared. Another expert who spoke out is Jim Rickards. He said that the financial world is about to face the biggest crisis in history. Right now, even though the global economy isn't doing well, the prices of all assets are going up. This is what they call the everything bubble era. We're living in a world where everything is a bubble. Absolutely everything. And if this bubble bursts, it could be the most severe crisis we've ever faced. When we get questions like this, we need to look at the data. If you haven't yet sat down to gather all the information about what's really going on, this video has compiled everything for you. What signals are there in the market? What are the economic charts telling us? What do the numbers say? Looking back at history and comparing past crises to what's happening now, how does it stack up? It's entirely possible that as we go about our daily lives, one day we might just wake up and find that everything has collapsed. When we talk about a crisis, honestly, if it doesn't happen, that's fine. But if it really does, being prepared can't hurt, right? And you can support the Sign Money Monster channel easily by liking, sharing, and commenting to chat with us. And what I'd love most is if you hit subscribe. So next time the wind blows, we'll get to meet again. Thank you. Let me say this first. The news I'm sharing in this clip, I'm not saying that we're heading into a crisis or that world war is about to break out. I'm just making an observation that the National Bank of Denmark has warned its citizens not to rely on just one financial system. They suggest keeping some cash on hand, about $250 per person per day in Denmark, just in case, whether it's coins or whatever, so it's easy to use if needed. So you can use it to buy water, food, or essential medicine each day. This information, by the way, I got from the official website of Denmark's central bank, where they advise people to have alternative ways to access money. They say that, in reality, Denmark's basic financial system is secure and still efficient, but there might be times when that usual level of security just doesn't work, and people should be prepared. This warning is actually very similar to the one issued by Sweden's central bank back in March. That's basically all there is to the warnings from the central banks of these two countries. How you interpret it is up to your own judgment. You might see it as just a routine warning, or you might wonder if it means a world war could break out, or if there could be a cyber attack, or maybe an economic crisis is on the way. Here on the Sign Money Monster channel, as you all know, this is a finance channel, so let me interpret this hypothetically. If the biggest financial crisis in history were about to happen, what would it look like? What signs could we look for? Let's just suppose for a moment that the reason they're warning us is because they know something, that the biggest financial crisis in history is coming. If that's the case, then the question is, so are there any real numbers or indicators that signal a crisis is coming? Let's look back at some comparison charts from the past up to the present. This chart shows what stock values look like as they form a bubble. When it peaks and then bursts, it turns into an economic crisis. The value just drops off sharply each time. For example, this peak here in 1929, that was the crisis. That was the Wall Street crash, a massive stock market crisis for that era. Next, this peak here is the stock market crisis caused by the European Economic Community, the EEC, in 1965. As soon as it peaked, it crashed. This peak is the Dotcom Bubble crisis, the internet company bubble. It peaked in 1999 and crashed hard in 2000. And this peak here, that's 2025, the present year as we're watching this video right now. But this current peak has not yet experienced a major correction. Still, it's even higher than during the dot-com bubble, substantially and notably higher, in fact. And this peak isn't just about the stock market. It includes the entire real estate market as well. Looking back at past crises throughout history, honestly, there has never been an economic crisis that was such a complex mix of everything all at once. It was either the stock market or real estate, but they were separate. For example, Wall Street was the stock market, right? The dot-com bubble was also about the stock market. Or take the subprime crisis. That was about real estate. You might think, wait, didn't the stock market crash too? Yes, but the subprime crisis started with the real estate market. The bubble burst there first, and then it dragged the stock market down. But it didn't happen because both real estate and the stock market bubbled at the same time. This time, though, it's like a double bubble. Both the stock market and real estate are in a bubble. Here's another chart that a lot of experts point to as a sign that the bubble is about to burst, the historical chart of PBV, or price to book value. If you're not familiar with PBV, it's the stock price divided by the book value, compared to the actual book value of that stock. If you look at this chart, you'll see that right now, the S&P 500's average PBV, or price to book value, is at 5.3 times. That means, on average, stock prices are 5.3 times higher than their book value. PBV is considered one of the indicators that signals a bubble. For example, during the dot-com bubble, when internet companies were in a massive bubble, the price to book value. During the dot-com bubble, the stock market's price to book value was 5.1 times. Today, it's even higher at 5.3. This 5.3 PBV for the S&P 500 is well above its long-term average. Looking at this chart since 1946, the average PBV was usually around 2, but today it's 5.3, much more expensive. Next indicator. Wow, S&P 500 prices are at bubble levels today. I'm talking about the P/E ratio, or price to earnings ratio, which is the stock price relative to earnings. Simply put, it tells you how many times the profit compares to the price you pay. It shows how many years it takes to get your money back. For example, a P/E of 10 means you'll recoup your investment in 10 years. Now let's look at the P/E ratio for the S&P 500. In this part, you'll see that 1/3 of the stocks in the S&P 500 have a PE ratio of 50 times. That means if you buy today, it'll take 50 years to get your money back. Honestly, 50 times is just the average, because for some of the really popular companies in the S&P 500, the PE ratio can shoot up to 180 or even 270 times. Companies like Tesla, for example. And what I'm talking about here is based on data from the S&P 500, which is made up of companies that are the 500 largest companies in the United States, right? It's basically the main market in the US. But there's also a smaller market in the US called the NASDAQ, which is mostly made up of tech companies and the like. So if you think the S&P 500 is already super expensive, the NASDAQ has grown even more. Even though the NASDAQ is smaller than the S&P 500, its market cap is now over 50 trillion US dollars. Some people have compared this, saying that the NASDAQ's market cap of 50 trillion US dollars is actually higher than the M2, or the total cash in circulation in the United States. It's more, by about 45%. Just think about it. The total cash in circulation throughout the entire US, when you add it all up as M2, is still less than the market value of the NASDAQ. So, are stocks expensive or what? That leads to the next question. If this indicator, the information I'm showing everyone here is actually really easy to find. If you want to look it up, just go online and you'll find it right away. Didn't anyone else see this? Can't they tell that the market is super expensive? Anyone can see it. Just go look and it's right there. It's not hard. But the real question is, if everyone can see how expensive it is, why does it keep going up? The only reason any stock price goes up is because people are buying. So the question is, who exactly is buying here? We'll break it down step by step, because there are both buyers and sellers, but the buyers and sellers are on completely opposite sides. For this, I started by pulling data from John Marshall, who's the head of derivatives research at Goldman Sachs. This chart shows the trading volume of ETF funds. Let me explain a bit first. There are some terms used in the financial industry, like money from big financial institutions. Things like that. They call it smart money. On the other hand, money from regular retail investors, everyday people who come in to invest, is called dumb money. So smart money and dumb money. If you look at this chart I got from the head of derivatives research at Goldman Sachs, you'll see the purple line represents retail investors, and it shows a lot of buying. Really a lot. It's shooting up. Meanwhile, the blue line, which represents professional institutions and the like, that means the smart money is actually moving in the completely opposite direction. In other words, they're selling off their positions. And if you want to dig a little bit deeper into this, I've gathered some specific data from Wealth Malone, which clearly shows whether corporate insiders like high-level executives are currently buying up stocks. According to this recent data from Wealth Malone, the top 200 insider trades, that is the top 200 corporate executives who usually buy the most shares, right now, out of those 200 people, the number of buy orders is 0 out of 200. That means not a single insider is buying at the moment. According to the account where I got this information, the author even said that this is a very unusual phenomenon. None of the top 200 insiders or executives who usually buy a lot are buying at all. So how should we interpret this? I'll share a theory about it in a moment, but first I want you to hear the opinion of someone else, Jim Rickards. He's a global economic guru who correctly predicted both the bubble crisis and the subprime crisis. Jim Rickards has come out and said that right now, all of us are living in what he calls an economic illusion. It looks like every asset is expensive, like everything is booming, but in reality, it's all a bubble. We're living in an era where everything is a bubble, just waiting to burst. And Jim Rickards says he can see that a crisis is about to happen because every crisis that's happened before has followed the same pattern, going all the way back to the tulip mania in the Netherlands. People started selling tulips and the prices just kept going up and up. Everyone was chasing after them, right? Until it turned into a bubble and then suddenly burst. The price of tulips crashed. Anyone who had been chasing after tulips and bought at the top lost out, one after another. As for how a bubble forms, Jim Rickards explained that there are 4 stages to watch for. The first stage is called the stealth phase. This is when people are buying, but they're not telling anyone. In this phase, it's usually the big financial institutions, what they call smart money, that come in to play with this asset. They start buying, but the mainstream media isn't interested yet, and regular people aren't paying attention either. The second stage is the awareness phase. In this stage, it's like, hey, if these big financial institutions are investing so much, should we follow? People start talking about it. Hey, if you invest in this, you'll get rich. Should we do it? It's still kind of an insider thing, but you start to hear whispers. And then the third stage is the mania phase, which is when hey, those insider whispers just keep building up until they can't be contained anymore. It all starts spilling out and the price starts going up. Wow, it looks great. Anyone who gets it now, everyone's getting rich. So it goes from just insiders and financial institutions to a much bigger circle. Everyone's getting in. You walk around and street vendors, taxi drivers, everyone's investing. And when everyone jumps in, the price just keeps going up and up. And as the price rises, people get even more greedy. Their eyes light up. And then what happens is, that's called FOMO, fear of missing out. When people are afraid of missing out, what do? They buy in. They throw more and more money at it, and the price just keeps going up and up. Right now, we're all in this phase. Like I showed you on the graph earlier, FOMO means there's a massive expectation from everyone that the stock price will skyrocket. Right now, whether it's PBV, which is 5.3 times, or the PE ratio of a third of the companies in the S&P 500 going up to 50 times. Another thing that Jim Rickards pointed out is that the risk is becoming extremely concentrated, and this is happening in the market right now. Let's look at this chart. You'll see that in the S&P 500, which has a market value of $49 trillion, a third of the market cap is already dominated by just 10 big stocks. And what are those top 10 stocks? Let's see. Apple, Microsoft, Nvidia, Amazon, Meta. Wow, all of these are AI-related companies. This is no different from people not diversifying their risk. because it's basically a huge number of people choosing to concentrate their money in this one industry. Just Nvidia alone now has a market cap of $4 trillion, which is equal to 3.7% of the world's total income, or global GDP. And the fourth stage before a crisis happens is the dark phase. This is when smart money or funds from large financial institutions start to flow out of the asset. In other words, they dump the asset. Are we seeing this happening now? Yes, we can already see it in the chart I showed you earlier. The purple line shows that the real buyers are retail investors, individual investors. But the so-called smart money, the big institutional funds, they're starting to pull out. At this point, Jim Rickards says the scary thing is that some people refuse to accept that this is happening because their money is already in there and they just can't handle the pain. So the question is, hey, if we can already see some signs, is there going to be any kind of warning signal before it really happens? The answer is, in past crises, there were no warning signals. It just opens its eyes and everything collapses. If you're not prepared, you won't make it in time before it happens. There are signals, but when it actually happens, there's always some kind of hellish moment. Sometimes it's not even something big. It could just be the last straw, something small that completely destroys confidence in the financial system. That's because the world's financial system today is built on trust. Honestly, the information I'm sharing here doesn't mean everyone has to believe it. It's just information. Whether a crisis happens or not, whether it hasn't happened yet or if it will happen, who knows? Maybe it won't happen at all. This is just information for everyone to use their own judgment. I'm just sharing this as a reminder not to put too much trust in anything. What I'm talking about is not to put too much trust in the fiat money system. Tangible precious metals, you should have some in your portfolio. Assets that are true stores of value that really preserve value, you should have them in your portfolio. Honestly, the crisis we're talking about here, whether it comes or not, we don't know. If it doesn't happen, that's definitely better. But what if it really does happen? It doesn't hurt to be prepared in advance. Thank you to Duchess for the coffee.